We're looking at the stock market in Nigeria. To start with, I would like you to give us a background into some of the trends and looking at the investment opportunities when it comes to the stock market in Nigeria. Maybe that should be a way for us to start this conversation.
Thank you very much. The capital market in Nigeria is a very strategic resource. It's a resource that without it, a nation cannot develop. It is an instrument for fund accumulation and distribution. It's an instrument for fund acquisition and distribution. It is an instrument for investors to put their money in productive areas and earn return on it. The capital market is also a resource allocator, pulling funds from areas of surplus and putting it into areas where they are needed, that can be deficit areas. For the government, it provides a veritable source of funding, but the government can use the capital market to a great advantage, as we have seen in the federal government and state government bond. Lagos State, Benue State, a lot of states like that have benefited from the capital market. We can see it from the government perspective as per the raising of funds through the issuance of sukuk bonds. We can also see it as a method of government trying to maybe privatize some of its organization and then telling those people that are buying them that they should put them on the capital market, thus improving the market capitalization of the Nigerian capital market. The Nigerian capital market is a very strong component of the Nigerian economy, and therefore a lot of efforts are put into ensuring its development. And in this regard, government agencies like regulators like the Security and Exchange Commission has done a lot over the years to ensure the development of the Nigerian capital market, licensing various operators and monitoring how they are performing, putting in intervention policies to ensure that the exchange, the Nigerian capital market is developing. Apart from SEC, we now have the NGX, the Nigerian Stock Exchange, that has now been privatized. And that is a sort of a marketplace whereby you can go for fresh fund in a primary issue. Let's assume that you are approaching the capital market for the first time. You can go for a primary issue. And if you are already a shareholder in all these public quoted company, you can sell your shares as a secondary issue. And that is why there are experts that have been trained through the Charter Institute of Stockbrokers that are stockbrokers that actually help in all these areas. And in the capital market, there are a lot of operators and facilitators. You will find the stockbrokers there. You will find the capital market analysts there. You will find the investment analysts there. You will find the fund managers there. You will find the trustees there. You will find fund managers, a lot of operators, all of them working together in the network to ensure that the capital market, which is the other hand of the money market. The money market is the market for short-term funds, while the capital market is the market for long-term funds. And there are stock exchanges all over the world, all of them being part of the major fulcrum of their respective economies. You have the Hang Seng, you have the New York Stock Exchange, and even the capital market does not stop at shares alone. You find out that we now have other exchanges, specialized exchanges like commodity exchanges. Nigeria has a commodity exchange, although it is still fledgling, but one day to go to that level of organization like the CBOT, that's the Chicago Board of Trade, and it will play a major role in the development of agriculture and commodity marketing in Nigeria. You also have the Futures Exchange. That one is the market that trade in exchange traded futures. That is contracts that actually put obligation and reward at a future date. And that is one of the methods of trying to manage risk by trying to enter into forward and futures contract. There's an exchange for that. Then there are also markets for options. Options are the privilege given to an holder of that contract to actually exercise or not to exercise his right at a given point in future depending upon the way the wind of the price is blowing. So you find out that apart from shares, we have commodity, we have futures, we have options as part of the instruments that are traded on the capital market. The Nigerian capital market is still developing, and there is a lot of hope based on the recent trends of capitalization. But a lot needs to be done in order to ensure that the market actually becomes one of the biggest in the world. With a population of over 220 million naira, and Nigeria does not have any reason not to have a very, very buoyant capital market that will be highly internationalized. And that is why we are not happy about certain stories of companies pulling out of Nigeria or pulling out of the stock exchange, like the GSK issue, like the Union Bank delisting, and things like that. It brings down the capital market. SEC has done a lot to ensure transparency in the market. Nigerian Stock Exchange has done a lot to ensure market confidence. A lot still needs to be done. Companies that are in buoyant section, like the telecommunications, should be made to get listed, like MTN, like Airtel. NNPC should get listed. A lot of other companies should get listed so that Nigerians can have a broad-based ownership. It's not that the ownership of all these juicy companies in the economy are in private hand. Everybody must have an option of holding an NNPC share or an MTN share because they are all contributing towards the development of these companies. So by and large, there are still a lot of opportunity for Nigeria Stock Exchange to grow. There are still a lot of exchanges, and the regulators must be given kudos for doing a very good job in the regulation of the market and ensuring that the market expands. Kudos must also be given to those that are training experts, like the charters of stockbrokers, Institute of Capital Market Analysts, Institute of Fund, Association of Fund Managers, and things like that. We still need a lot in this area. And capital markets should be introduced into the curriculum of even from secondary school. Let them know a lot about the capital market so that they can position themselves.
For those who are just new when it comes to stock investment, you know, they are for new players or new entrants into the sector, I would like you to educate them on what they need to do when it comes to investing in stock market. Take them to the processes involved, the documentation, and the sensitive areas they need to work on to ensure that they get the proper investment done.
Thank you very much. When you are talking of new entrants, are you talking of investors that want to buy shares on the exchange or those that want to raise money from the exchange?
Let's look at the both ends. So would you do a proper education when it comes to these two players?
If you want to go into the capital market to raise funds, there are two approaches to it. The first one is that, are you already an organized company trading like what GTB did when it came to the market? GTB was already existing as a major bank, but wants the shares to be quoted. In that instance, all GTB needed to do then was to go by introduction. Introduction means that I have my shares. The shareholders are holding the shares, but they just want it to be listed. In that instance, it is an offer by introduction. Then we have the one that we call offer by subscription, which now means that you are going into the market to raise money. And all these rules and regulations are not cast in stone. They change from time to time, and you have to go to the rule book of the Securities and Exchange Commission, because number one, you have to register your operations, that capital raising operation with SEC, that's the Securities and Exchange Commission. You have to pay certain fees and you have to get certain documentation. Because even if you go and look at the Company and Allied Matters Act, there are requirements that you must have as an incorporated company. You can't go to the capital market without being an incorporated entity. And then for you to now become a publicly traded company, there are a minimum number of shareholders you must have. in order to be a public company, because a private company has very, very little number of shareholders, while when you are talking about a quoted company, at least must be not less than 50. You have to go and register with SEC, obtain all the information that is required, documentation you have to submit, and you can't do this without financial advisors. Those financial advisors are mainly stockbrokers and other advisors. You have to have your lawyers. You have to prepare a prospectus. That prospectus is a body of information that investors that want to buy your shares will get all the information they need, and it has a legal implication because you cannot lie there. So in order to protect yourself in the prospectus, you put a lot of caveats there. You make yourself come clear. You put information about your incorporation, about the memo and activity, memorandum and articles. You put information there about your activities, about your directors, their consent to be directors. You put there the story of what you want to do. How much shares do you want to raise in the market? What are the denomination of the shares? Mostly now you go to the stock exchange, the par value of most of the shares that are listed at 50 kobo per share. Par value is the face value of the share. It's different from market value, because market value now is when your shares start trading, the expectation of the market and their perception of your operations and potentials will determine how people will say that they want to, the price they will place on your share. 50 kobo share we have seen can be sold for 200 naira. We also have companies that have 50 kobo par value share trading at 40 kobo or even 30 kobo, lower than that. So when you package all this information are available when you get to SEC, you can get a copy of a prospectus. When you put all your financials down, historically, if you have been operating, forecast, and historically, if you have been operating, forecast alone if you have not been operating. And that one will have to be attested to by a reporting accountant that will look at all those figures and then put a report there that we have examined all these things and people can rely. Because if any of these professionals lie or they make a mistake, that in law we will call a misrepresentation. And we are talking about misrepresentation. It is nearly a criminal offense that people can go to jail for. And in that instance, you have to look at the case of Edley Bryan versus Ella and Partners, because misrepresentation can be innocent, it can be fraudulent, it can be innocent misrepresentation or fraudulent or negligent misrepresentation. And the implication of all this are left to the court to decide. But professionals and the issuer must ensure that all the facts they put in the prospectus are factual, they are not misleading, and they cannot. Well, if you mislead any investors, they can come back to claim against you for the damage they have suffered. So that the key document there is the prospectus. And there are investment advisors, like I said, stockbrokers, consultants, issuing house. Because if you want to issue shares, you need apart from the stockbrokers, you need an issuing house. That issuing house are financial advisors licensed by SEC to assist companies to raise funds. And all this documentation will be packaged by an issuing house. We have a lot of respected issuing house, Greenwich, Apple. I'm not advertising for anybody, but we have a lot of respected issuing houses in Nigeria with cognate experience in fundraising. In relation to documentation, packaging, and things like that, your issuing house is very, very critical in whatever you are going to do. And that is why you now find out that even if you want to raise money, apart from offer by introduction and offer by subscription, we have offer for sale. Offer for sale is a situation whereby an existing organization that already has its shares now want to offer some of the shares for sale. That's why I find out that companies at times will have a combination of offer by subscription and offer for sale. Offer for sale, existing share, people that are already holders of shares in that private company want to offload their shares to the public so that they'll be able to gain from selling those shares at higher prices than par value. When you now find out that the capital market is the one that determines the mechanism for determining the price of shares, there are what we call over-the-counter market for unquoted shares, because at the end of the day, even if you are talking about buying shares at Hallmark or Sainsbury, you can also buy from a grade 1. So there are those ones that are not quoted, that You can now go to over the counter market to get a sort of a mirror price or a shadow price of shares that are being sold there, so that holders of those unquoted shares can also have a sort of an avenue for disposing of their shares. This goes as far as for those people that want to issue, because apart from issuance, another mode of issuance is when you want to do right issue. Right issue is when existing shareholders are being told to come and buy additional shares, and they have to buy it in pari passu to the same price to everybody. And those prices are usually slightly lower than the current trading market price, in order to give those investors a leeway to say that, why am I buying right? Why can't I just go to the open market, to the capital market to buy straight? So that is right issue. All these things are those things that those methods that those people that want to raise money from the capital market can do. You can also raise money through exotic means like mergers and acquisitions. I wrote the first book in Nigeria on that topic in 1991. And we look at mergers and acquisitions as a method of raising funds. You can see a company that has a lot of money, but it doesn't have defenses to defend itself.
I would like you to educate our viewers. What are the risks involved when it comes to stock market? Then how do you manage the issue of volatility so that at least you can get productive results when it comes to stock market investment?
Thank you very much. You have hit the nail on the head by mentioning volatility. When you have volatility in the trend of anything, that means that risk is involved. Risk is a situation of uncertainty. When you cannot predict with certainty that this is what is going to happen. And the capital market is awash with a lot of risk. And these risks are so varied because of the fact that apart from the risk in the economy itself, which we call systematic risk that cannot be controlled. Those are the risks that maybe inflation is there, there's nothing the company can do about it. Exchange rate risk is there, there's nothing the company can do about it. You'll find out that interest risk is there, there's nothing the company can do about it. These are what are called systematic risks. But when you now look at unsystematic risk, those are the risks that are not flowing from the economic system. Those are the risks that the company and the investors can take measures to mitigate. And that is why when you are now looking at pricing, either ordinarily or by algorithm or any other method, that's what we call the beta factor. That's why we now look at what is the extent of riskiness of this investment. Before you make any investment, you have to go and look at the beta factor. To what extent will any variation in all this risk affect the return? Because of the fact that investors are actually trading on a risk-return basis. The higher the risk, the higher the return, although not in every instance. If somebody does a lot of illegal things, because of the risk of getting caught, the return on those illegality are usually very high. The same thing for people that cut corners. So when you are an investor, you have to look at the risk involved in the organization you are trying to buy their shares. In the first instance, what is their profit history? Have they been making profit or have they been making losses? What is the audited account saying? And you have to carry out a lot of analysis. And that's why you need an analyst to now look for you at that this is the result of this organization. When you analyze the result, you can now see the trend of that organization. You have to look at the liquidity. There are liquidity risks. You have to look at solvency, the fact that that organization may not last well into the future. There's no point going to put your money into an organization that will declare bankruptcy within a year or two, and you've already bought the shares. The incidence is that you will now be left with semi-dead shares. That's why you have to look at the solvency, apart from the profitability. Even if the profitability is high, you have to look at the solvency. You have to look at their capital market history to now look at how have they been performing in the capital market. Those ones are those things you are going to look at: liquidity, solvency. You have to look at investability. Are the stocks worth investing in?
And for you to now look at investability, you have to look at the earning per share. How much is the share earning? Per share, how much is the share earning? That is the profit divided by number of shares. You can't go for an organization that is earning 50 kobo per share while you are leaving an organization that is earning 2 naira per share. And all this one has to depend upon what is the market price, because a 2 naira earning per share organization may likely have a higher price than the one that is having 50 kobo per share. And that is why you have to relate earning per share to the market price per share. And that one will give you a very important metric that we call the price earning ratio. So company with higher P ratio are likely to be more valuable. And that's why you need support of experts, capital market analysts, stockbrokers, financial advisors, and consultants to advise you when you come to valuation, because you have to value the shares to make sure that you are not even buying the share or entering the market when the price is high. And that is why you have to look at when the market is bullish and when the market is bearish. A bull market is a roaring market where prices are moving up, moving up, moving up. Don't follow the greater fool theory. Greater fool theory establishes that a fool will buy an overvalued share at a very high price, believing that a fool that is greater than him will come back to buy the shares from him. You may not get a greater fool. Therefore, that person will be left with shares that are actually on his hand. So there are a lot of risks, and that risk has to be taken into consideration. For instance, what is the quality of management? Who is at the helm of affairs? Who are their board members? Do they have pedigree? What is their profit history? What is their sales history? What is the stage of their product in the product life cycle? And that is where marketing has to come in. I was at the time the president of Charter Institute of Marketing. So you have to actually go and meet professionals that are nearly all-rounder that will tell you that the product of this company is going into their maturity stage, and they don't have replacement product, because when they enter into maturity stage, you find out that they are not earning as much as they earn, and the company will start experiencing a fall in prices. You have to look at the nitty-gritty, dissect the operations of the organization to look at their income earning capability. All these things are things that have to be taken into consideration before you buy any stock. Then I've mentioned that you have to look at the market side to look at whether it is bullish or bearish. You try to buy when it is bearish. You don't buy when it's bullish, because when you buy at a lower price, no fully well, the market will make a turn. One day, the market will rally. And when the market rallies, if you want to exit, you can exit at a higher price. Not to buy when it is bullish, and by the time the market is, you are going to sell, the market is bearish. That is where the state of the economy, the one that I called part of the systematic risk, come in. What is the economy all about? For instance, we are now seeing the effect of exchange rate, and prices are going up, inflation are going up. When you now look at the confluence between inflation and interest rate, you can bring it in and try to see how you will take advantage of the opportunities that are available now, or you tarry a little to see where the economy is going, so that you will be able to make a better decision. In all these instances, you need the support of experts and advisors. When you now identify all the risk, interest rate risk, political risk, those ones are part of systematic risk you don't have control over. But the one you have control over, you have to pick the type of company you want. For instance, are you going for an all-dividend payout company? A company that every profit it makes, it will distribute it as dividend. I think Nestle used to do that. Or you are going to look at a company that will not give 1 naira dividend, but they will invest all the money they make, like the company run by the sage of Omaha, Warren Buffett, that is Berkshire Hathaway, that will always not pay dividend to anybody. If you need dividend, you go and sell part of your share. That is what is called homemade dividend. Homemade dividend. You are making dividend by yourself. And then you now look at the fact that when you are investing, all your information and everything will have to be very, very accurate, because they may want to pay you dividend and they may not be able to remit it to you. That's why SEC has brought in a renewed platform for e-dividend. So that because over the years in the past, companies used to just sit down on other people's dividend and they use it as a source of spontaneous finance. That is finance that they are not paying any cover on. If those persons come, fine. If they don't come, it becomes part and parcel of the working capital of the organization. So you have to look at the dividend history. As an investor, what is your lineage? Are you leaning towards getting as much money you want, or you are looking for capital gain? Because you also have to look at safety. There's what you call safety first principle. You look at safety to look at whether that investment is safe. Then when you want to buy shares, you also look at the marketability. That is, can you easily offload all those shares? Is the shares really an attraction? Is it a not cake on the market? You may end up having shares that you will not be able to sell. There are shares on the market that are semi-dead. If you buy such shares or you now get hooked into it, you may be hooked into it for years. You may not be able to sell or dispose. You have to look at safety. You have to look at liquidity, which you also call marketability. When you need your money, can you easily sell all these shares? So now you also have to, like I said, that you have to look at the quality of management, and you have to look at the trend of the price. So when you want to now look at the state of the market, you have to look at the stock market index. Is it rising or is it following? We have the all share index of the Nigerian Stock Exchange. There are other indexes you can look at. That is the average trend, whether the market is upbeat or is actually coming low. Then you have what analysts call advanced decline rule. That is how many stock advanced today, how many stock advanced decline today. You can now plot a graph, and that one will show you the trend of the market growth, the direction of the market, as to whether the market is coming down or the market is going low. Like I said, buy bearish, sell bullish. That is the most important thing that you have to take into consideration. And when you want to protect yourself against this rule, there's no option market or not well developed in Nigeria today. You can go into option. You can buy option contract to protect your position. That is what you call hedging against risk. Hedging means that you want to protect yourself against risk so that even if at the end of the day you are not making a gain, definitely you will not make a loss. You can enter into option contracts in order to protect yourself as an investor. It can be a put option, an option to sell, or a call option, an option to buy. So that one is a topic for another day, because option is already is another ball game itself that can only be played by very, very informed and sophisticated investors. But it remains an option of a method of hedging yourself against risk, and those are the risks that you can control. And if you note that the market trend is going down, you must have a stop rule. That stop rule will say that if the shares should fall up to this point, I have to sell. You can give your stockbroker a stop limit order that when the shares reaches a given price level, you have to sell. And that's why a lot of people got into trouble during the top margin loan at the turn of the decade, like the turn of last decade, that actually bankrupted a lot of people and put several banks when there was global financial meltdown. You must know when to sell, when to exit, and you must know when to wait.